So FOMC turned out pretty good this week. Market kind of went straight up afterwards for the next 2 days. It did slow down a bit today on Friday, but overall, I'm like more bullish than I have ever been. Do you feel the same way?
Yeah, I do to a degree, right? Because like obviously there's certain factors that within our system that give us green, yellow, and red lights, right? So like when the green lights are printing, like you have to take advantage of it. So I'm with you on that. And I think that like the way the FOMC went this week, I don't think many people were expecting it. Obviously, hence the move in equities afterwards. I
Well,
just
what
don't
was
think.
so unexpected? It seemed pretty much in line with everything that we've been thinking and saying.
I think that people weren't thinking the Fed, like Powell was going to say anything about adjusting the taper. So I think that kind of caught people off guard. And I know some, like, so there's two sides of the discussion, right? Where people are like, okay, Powell's gonna start tapering soon, and there's people that are saying there's no reason for Powell to taper. But I think the general consensus in the market was just there's no reason to really cut in stop. Excuse me, not cut interest rates, cut the rate of runoff on the balance sheet. And I think that when Powell said that, that's something that they're going to make adjustments soon on, um, people got people started to realize that QT was going to slow to a degree, right? Now, obviously, that's a bullish factor, right? You don't need as long as QT is there, it's negative, right? But as QT slows off, even if it's not QE, it's just more positive, right? So it's like a more positive shift for the market. The market goes up, and the other thing was Powell reaffirming the three dot rate cut agenda that the Fed laid out, right? Saying that, or not Powell, I shouldn't say Powell reaffirming, right? More so like the dots reaffirm that the Fed's still looking at three rate cuts now. If we take a look at the overnight the Fed funds futures, the number of hikes and cuts, you can see that the market is back to where the market today is back to where it was about 2 weeks ago. But what you can't see on this graph, and for those listening and not looking, I'll tell you, is the market pretty much almost priced out that third rate cut by December going into FOMC. So the market was thinking we weren't going to get three rate cuts. Instead, we were going to get two. So adding that extra rate cut, adding the verbiage around slowing QT, I think overall was just bullish equities, right?
Yeah,
It
and
was just
this
bullish risk on assets.
in a way, it actually kind of lined up with what we've been saying where the Fed is going wrong, where they needed to start cutting rates already. Whether it's even just one cut, they needed to start already because they need to get ahead of the curve. They can't start cutting once they already see unemployment rising. Once unemployment starts rising, it's already too late. It
Right. So
rises very quickly, and by the time their rate cuts even bleed into the economy, it's going to be too late. So they need to be ahead of the curve. So the fact that they're talking about slowing QT, even though it's not necessarily a rate cut, does kind of line up with what we've been saying they need to do. Although they are still pretty behind the ball, I think they needed to cut last meeting. But obviously, they don't want to run into the scenario where inflation does get ahead of them.
yeah, I think that's a good point, right? Because like we can we spoke about them actually. We were speaking about the Fed cutting in December, right? We were saying like that's probably a good point to start the rate cutting cycle. But the problem is, and the reason why they can't, and we said this I think in the podcast or the podcast thereafter, is that once the Fed goes, the market's going to expect some sort of methodical rhythm, right? Where it's like, okay, 25 basis points every meeting. And if the Fed is going to cut interest rates over the next 2 years at a cut every meeting, they're going to end up at 325 basis points or 3.25%, right? And if you don't think they should start cutting now, you're betting that inflation is going to be higher than than the 2% target 2 years from now from where the Fed is right now, right? Remember, it's a catch-up game. Like the Fed doesn't want to panic cut, right? They want to ease into it because they're looking for the soft landing. They don't want to be chopping 50 basis points off the funds rate at every meeting, right? That's not what they want to do because just remember this. At the end of the day, the Fed has built up ammo in this rate hiking cycle. They have built up rate cut potential. The problem with the reason why when the Fed's at zero and things get bad, or when a central bank is at zero and things get even worse, they tend to look at or even go negative because they need to be more stimulative. Now,
Yeah,
I'm not
which I
saying
don't
that
think America wants to even be in that position of negative interest rates.
I don't think we ever will, but where I'm going with this whole thing is the Fed. Think of the Fed as like every 25 basis point of a rate cut is a round in the chamber, right, or a round in the mag, right? And they have built up a magazine stack here where they can start firing rounds if they need to bolster that soft landing that they're shooting for. But if they don't, if they shoot too quickly or too much, they end up overstimulating the economy and they have to start rehiking again, which I think we're at a point where the Fed could start rate cuts right now. 25 a meeting. Or if they really wanted to be conservative, 25 every other meeting, which is what we were speaking about a couple of months ago, at least setting the stage. But 25 a meeting right now would bring that Fed funds rate down with the rate of inflation. Now, I know there's a lot of people that are saying, "Oh, the Fed's not restrictive. Inflation is up." Inflation is not up. Okay, if
Well, so
inflation's up,
an argument that I actually see a lot is how can the Fed cut rates, or some even saying how can the Fed not raise rates even more now if you're seeing Bitcoin shooting up, stocks shooting up, all of these altcoins and just money flowing everywhere. How is this an environment that is restrictive? That's an argument that I see all the time. Does that really matter?
no, I don't think asset prices really make the that big of a difference in terms of restrictiveness. Because so just because the Fed, so like I think the best way to think about it is this, right? um, Asset prices have their own proxy. Like the Fed is restrictive currently in a positive growth and positive inflation environment, right? Where inflation has some firmness to it. That firmness, like, and I want to go back quickly to what I said earlier, where people are claiming inflation is accelerating, right? Inflation is not. I mean, if you take a look at this graph here, yes, inflation has seemed to have bottomed around 3%, but we can talk about inflation accelerating when we're above 4.5, and we start moving higher, right? These bumps along the road, this is nonsense. This is noise, okay? And people are extrapolating this data through some super coarse, idiotic metrics saying, look, okay, we're heating up. Just wait. Headline is what matters. The Fed really focuses on PCE, but headline is just a broad measurement, right? And it's a universal broad measurement, and it's something that again, like we're in a range here, which we have been telling you guys for a long time that it's very hard to get inflation from 9 to 2. It's very easy to get it from 9 to 5. That last mile, that last stretch there is going to be a fight, and it's what we're seeing right now. It doesn't mean that inflation's going back up to 9%.
Yeah.
And I think the whole point, the reason I bring this up with your question about risk assets going to highs, is you're in a positive growth environment with positive inflation. The Fed is restrictive today, but they're also restrictive on a forward basis. If we look 1 year ahead from where we are today, the Fed funds rate 1 year from now is expected to be at least 200 basis points or 2% higher than the expected inflation rate. So the Fed is still restrictive 1 year out. So in this scenario where the Fed is restricted today and 1 year out, asset prices are going to inflate with inflation and positive growth. So you can't just look at something like the stock market and say, "Oh, the stock market's at highs, the Fed's not restrictive." The restrictiveness of the Fed has to do with credit conditions, which we can go back. We can talk about things like the Nasdaq, right? So the Nasdaq being at all-time highs is one thing. That's okay. You listen. These are the best companies in the world. Literally, the best companies that are walking this planet right now are in this index. Okay, and they're at record highs. You can't argue that. But then you pull up something like IWM, and this thing still has at least what 10, 15. What do we have to all-time highs here? 15% all-time highs. So there's obviously a disparity going on here. This isn't just all risk assets. And then the next question, I know someone's going to ask about crypto. Yeah, Bitcoin again, an asset, no debt, no balance sheet, no CEO, no earnings, right? So Bitcoin theoretically has the most symmetrical profile to a large cap blue chip company. And that we're not talking about risk profiles, we're talking about fundamental profiles, right? It doesn't care, it doesn't have debt maturities to look forward to, it doesn't have these obscure things that are holding small cap companies back, which is probably why you're seeing it trade so well and at all-time highs or near all-time highs with equities. And I
But
think that
doesn't that mean that people just have money to throw away? They have money to buy these altcoins with and Bitcoin with. Isn't that a sign that they're not restrictive enough?
I wouldn't say so again, because there's been too many points in history where the Fed was restrictive and equities were at all-time highs. So like I don't think we can make that judgment. And remember, the Fed being restrictive has something to do with like lending markets and credit markets, right? So in terms of, like, for example, the Fed being where they are, mortgage rates are high, right? So mortgage rates are high. You can't deny that there's been a slow in in terms of home building, right? Or I shouldn't say home building, home sales, right? You can't deny that home values have slowed. They're growing, but they're not growing at the rate that they were before, and therefore other people that can the access to credit there is constrained as well. I don't think when you look at the market, you can think of, like, you can't really look at equities and compare them to credit markets at the same time, because access to credit and access to capital that you already have are two different metrics, right? For example, the investor has $100,000 or the investor wants to borrow $100,000, right? The
Yeah.
investor that has the $100,000 wants to do something with the money. The investor that borrows $100,000 has to incur a cost to get the money. So I think there's two different there's two different monetary scenarios that you can compare this to. And again, when we look at this in terms of restrictiveness, if inflation is still above target, the Fed is not in a point of restrictiveness where the inflation rate, they're not at a point where inflation is so low that we are now playing, or growth is so low where we're playing with growth, or we're playing with inflation. I want to repeat that. The Fed is not yet at the stage where their level of restrictiveness has bled completely into growth, right? And therefore growth is not, I mean, if we take a look at GDP now, right, we're at 2.1%. We've been in the twos, threes, right? We're doing solid with GDP. So growth is not being yet affected to the degree that it should be if the Fed is to stay here for some time. And this goes back to this being one of the fastest hiking cycles that we've seen, right? So these lags of Fed policy have yet to hit the market. And I think that, like I said earlier, there's a difference between somebody that has assets and somebody that needs to borrow assets. And I think that the biggest explainer to that, or the easiest way to simplify that, is to just look at the Nasdaq like we just did, right? Look at this and then look at something where there's more troubling capital, right? Like IWM. Completely different scenario.
Mm.
Now, when growth is positive, it bolsters this though. It prevents, companies are still growing. You can claim some are sandbagging or they're guiding lower, right? But they're still growing, right? To a degree. Most companies, right?
Yeah. So
And
also at the end of the day, with inflation being where it is, it's still elevated. It's still above their 2% target. That's always going to be a force pushing asset prices higher, whether it's real estate or equities. It's going to have an effect, an upward effect on it because they are the most inflation sensitive things on earth is as assets. So having this 3% inflation rate remaining sticky here, it's really not a good time to be bearish because this isn't the kind of inflation that caused us the 2022 dip in the stock market. That was inflation that was out of control and unpredictable. Now,
right.
even though inflation is elevated, it's in control and it's predictable. And so the stock market's going to run with it.
Right. And this goes back to what I said, right, with the positive growth scenario here, too. You still have that growth factor being positive. And we look at new home sales, they're up off their 2022 lows, but we're not seeing these home sales really breaking out, right? We're not above 2019 levels, right? We're not even above 2023 levels at this point, right? Like we're down, but we're not breaking out. We're not really breaking down. So it's kind of like this state of levitation where the Fed is restrictive enough, in my opinion, on the economy. And that restrictiveness is continuing to bleed into the economy. Therefore, the rate at which things are affected are very disproportional. So you can't just look at something like the Nasdaq and say, "Oh, it's at all-time highs." Um, well, obviously the Fed's not restrictive enough. Again, talking about companies with low debt, high high rev numbers, strong pricing power, right, in terms of what they have, and just monopolistic companies that fell so much in 2023 or 2022 because there was this idea that higher interest rates, that they were more sensitive to higher interest rates than in reality and what they are, right? That's what
Yeah.
happened in 2022. Those companies completely fell. There was a bump along the way in growth. Those companies fell, but there was this belief that saying like, look, high rates, high bond yields, no good for tech. There was this, prior to 2022, there was this whole consistent narrative in the media saying rates up, tech down, right? And that's always been nonsense going back many years. But in recent years, up to 2022, there was a correlation there, and a lot of people just assume that rates going up, tech's going to go down. They sold off tech hard, and in the process, growth did slow along with it. We had those two negative quarters of GDP in 2022, and I think it was Q1 or Q2 2022, and those tech behemoths
I
they
almost
felt
feel like growth slowed that time because everybody was expecting a recession. It was kind of like a self-fulfilling prophecy.
that's always a possibility for sure. Yeah, I mean there was a lot of things that happened back then where like the companies got ahead of the curve and they started doing mass layoffs, right? Like we saw the job cut numbers really spike in 2022 ahead of all this 2023 or later 2022, and now all these job cuts, like the job cuts now in terms of where they were are still below what we saw in 2022.
Yeah. Well, so
So
we're still in stage three of the compound landing, and stage four of the compound landing is when the Fed remains restrictive for too long, kills growth, and that's when we get the hard landing. The Fed scrambles to cut rates. Do you still think that that's going to happen, or do you think that they're going to actually achieve this soft landing? Because it really does seem like they are on track to achieve it.
right, so the soft landing is one of those things where the reason everyone believes in it, or a lot of people believe in it, is it's something that you can believe in, right? It's very possible that they can pull it off. And when I say that, I say it with caution, right? In terms of, I'm not saying like it's something that I feel like it's going to happen, but it's a possibility. We have to accept that. And the risks are this: the risks are the Fed doesn't bring interest rates down fast enough, or I should say, in a rhythmic pattern that offsets the decay in inflation we'll see moving forward, right? Because, and this goes back to what I said earlier, the reason equities are at their all-time highs right now is, look, the Fed the Fed is still restrictive, but we haven't. It's not like we're living in a 5+% environment for for more than 2 years at this point, right? Like the Fed started lifting interest rates in 2022. It's 2024. By the time they got up to 5%, we're not even at 5% for more than 2 years. So to think that like all that rate hiking progress has been flushed through the economy already is, I think, a bit naive. So we have to look at it forward, and that's what's going on with the market, right? Like obviously we can take a look at payrolls, right? And this goes back to that soft landing scenario. The payrolls are still being increased on a year over year basis at almost 1.8%, and this is the revised data. So this is measuring the last data point to the data point of this period a year ago, right? Year over year. And even if we go back a couple of months, like you can see there's resiliency here in the employment numbers, like back to like the 2012 to 2018 area. We're at that level. We're not down in the negative territory, which is usually what encompasses a recession, a contraction in the labor force. We're not yet seeing that. And I think that There's a lot of reasons for that. The Fed's restrictiveness hasn't bled into the economy. Okay. The economy is a bit more resilient than it normally would be because of the excess it built up during COVID. I think that there's a lot of things that Powell says that make sense when he's saying that, the post pandemic economy is different. And there are some things that are different about it in terms of the gluttony, in the job openings. Like there's just a dynamic that nobody's really seen. So it's very hard to time that recession, which makes it almost nearly impossible for the Fed to execute that soft landing if they start hesitating now. They have to really come in and land the plane, right? In terms of bringing rates down softly, rhythmically, and with inflation as inflation progresses lower. Now, there's a risk of overstaying their welcome and therefore then having to cut. I think that's the most likely scenario, right? I do believe that we're going to see a hard landing at some
But
point.
we are seeing them already talk about tapering off QT. So isn't that technically a step in the right direction?
Yeah, I listen. I think that was a little bit of an look. The QT talk was, I think, a bit unnecessary to like kind of poke it in there the way they did. But I understand why they're doing it. Like you said, yes, it's a step in the right direction, right? So there's very little stress in the money market in the money markets at the moment, right? We can see here based on the SOFR spreads, and we're really just at the lower bounds of the overnight reverse repo like floor here, right? We're not like the spread isn't blowing out as it did in the repo crisis, and the Fed, I believe, the reason why they're modifying their balance sheet runoff is the balance sheet right now is running off at an annual rate of about 10% per year, like in terms of a decline, right? Year over year, the figure's down 10% from the prior year. Okay. Now the problem with this is their runoff is not a figure like this. It's not, say, they don't target, one basis point a month or something like that. They're targeting um they're targeting is solid numbers, say like 95 billion dollars worth of securities maturing every month. They're going to let roll off. So I think the Fed kind of wants to get ahead of the curve because they don't want to like sit here and give the market this idea that they're going to let this number just they're going to let the balance sheet just drain, right? They're going to get ahead of it. And Powell made it clear that he wants to make some adjustments to the balance sheet to where they can continue the runoff at a more sustainable pace. And I think what he's trying to say is that this $95 billion figure, we don't need it to be at 95. If the economy is if they're attempting an actual soft landing, they can drop that number a little bit, let the balance sheet continually run off, right? And they don't have to worry so much about overdoing it as they did in 2019, where they created that repo crisis, where the lending rates blew up across the ceiling, right? The IORB rate, and the Fed had to basically step in and conduct not QE, right? They don't want that situation to happen again. So I think as they progress there, and if we take one final look here, and we look at the balance sheet, a lot of people say, "Oh, 7 trillion, big number, right? Very problematic, whatever it may be." And I think like you also have to put it into perspective that the central bank is the central bank of the United States, right? So their balance sheet is theoretically, while independent, it's a factor within the economy, right? So if we take a look here and we just look at their balance sheet at face value, I mean, you could see it's just up, right? This orange line, it's just up aggressively on every type of crisis. It just rips, right? But let's adjust the balance sheet for M2 money supply, right? And you start to see that the balance sheet right now, if you adjust for M2, is below the 2014 highs. So in relation to the money supply, the balance sheet's actually lower than where it was in 2014. Now let's adjust the balance sheet for GDP. The balance sheet is back to almost 2014 highs. Now it doesn't look that way when you look at the balance sheet on face value. If I were to hide all this stuff, right, you would think, oh, there's no way, like the balance sheet's just up. And in reality, like it's not, right? Like yes, it is, but the economy has grown too. So the proportion of what the Fed is holding in relation to just GDP, for example, with what we're looking at here, is much less, right? So the Fed's almost back at 2014 levels. If the balance sheet was going to go back to 2014 levels, it would still have to drop another 36%.
Right. So if you're just looking at it at face value like that, it's never going to get back to those previous levels.
Right. I don't think it is. I mean, like, look, the balance sheet's never going to zero. This is the Federal Reserve. Okay. In some ways, it's a joke. We all know, like, the next crisis comes, they're going to pump this up. But I think you have to kind of look at it into a relation of just something simple like GDP or money supply, give you kind of a broad range of what's going on. Because if you take it, like I said, you put this on face value, it looks like the Fed has reduced nothing, right? Like we look at the orange line compared to where we were post COVID, like this is a joke. But then you take a look at it and compared to where, GDP has gone since COVID, it does a lot more damage to the downside here, right?
Right.
Like, and I think that's something you have to pay attention to because if you look at it in relation to the economy's value, the Fed balance sheet is shrinking. And I think the Fed wants to prevent any scenario where they're seen as taking too much off the table too quickly and theoretically skirting around the soft landing because of malpractice. Now, I do think, unfortunately, they are going to end up skirting around the soft landing for malpractice because they're not going to cut rates fast enough. But that's something that we're just going to have to wait out and see. And I don't think until we really get started with the rate cuts are we going to really get a good gauge because, right now they're pricing in 3 rate cuts, but there's a lot that can happen. I mean, all it takes, as we said earlier with the inflation chart, all it takes is just one little print up, right? For everyone to start really questioning it. If inflation printed 4%, right? 4% year over year, people would the Fed would be shaking. Even though I still think that's in bounds. If we had an out of sample print, but basically an out of average print at 4%, right? Like something that just, seasonality effects, whatever it is, base effect, whatever it may be, right? Base effects in commodities, give us a 4% print, and it kind of got running in the media and people started picking up on it. I think the Fed would be scared, and maybe they would. Those are things that would slow them down. Which in reality, we're again, in the forward markets, the Fed is still restrictive on a 1 year forward basis, and I think that if they don't cut, what's going to happen is inflation will start dropping at some point. And remember, they only meet 8 times a year. Inflation gets reported 12 times a year. So they're at some point they're going to be caught, with a downwards inflation print, and they're going to be wondering, oh boy, like the next meeting we have to start cutting. And at that point, depending on the trajectory of inflation or how aggressive the regression in inflation is, wherever this breakdown does occur, I think that there's a chance that the Fed should have been cutting up until that point, right? Because we know inflation's lagging. We know that this is a lagging number. So by the time this starts printing in the 2s, the Fed should be at least 3 rate cuts in. The problem is they may wait too long, and then they're going to start chasing a falling inflation number with 25 basis point rate cuts. And they can only cut 200 basis points pretty much a year, right? So think about that. They can only cut 200 basis points a year at 25 basis point rate cuts. So at what point do you end up in a situation where the Fed is not catching the falling knife properly and they just end up cutting themselves? And that's really the compound landing. So I think that's where we should wrap up the pod this week. If you guys have any questions, feel free to reach out to us on X at the Market Radar or go to our website at market-radar.com.